Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'm going to sprinkle in my financial opinions as we go. It's going to be commodities, wealth building, and or financial topics that I'll cover. And I'm going to give you my financial opinion as we go through it together. So let's dive in and see what people are talking about on Twitter. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com. We do have a discount going on. It's in the description link below if you'd like to join to see what kind of sectors, what single companies I'm purchasing right now. You can see my purchases, when I buy, when I sell, and my portfolio holdings. So let us know. Hedge funds sour on crude oil with least bullish positions on record. Least bullish positions on record. And that is generally when you want to put the most bullish positions on. I just saw Warren Buffett had bought some Oxy. I'm looking at some of these energy service companies. And with the least bullish position on record, this is generally a good time to be looking. It means people aren't positioned in it. And then when the positions start to be put on, that drives demand. It drives the price of crude oil higher as those go up, generally speaking. So a lot of length has come out of the market is what basically we talk about. So hedge fund slash bullish bets on crude to a record low, with markets gripped by concerns about excess supplies and mounting skepticism that OPEC Plus will deliver all the supply cuts it has promised. I'm going to skip this one. Compound annual performance of S&P 500 sectors since 2008. Now, 2008 is when we had the crisis. That's when we had our hypersupply of real estate and the crash from that hypersupply. If I were to guess, if I were to put bets based off the real estate cycle from 2009 till today, I would say that technology stocks would be the best bet to make. And then eventually what's going to occur now that we're in an expansion phase of real estate and we have an increasing interest rate environment, and we're in that portion of the inflationary cycle, that energy will be the best performer over the next 5 to 10 years. So that is exactly what bared out. Technology stocks were the best under that recovery phase of real estate. But that's going to change to energy. Energy is going to be the best performer over this next 5, 10 years. This is going to go all the way to the opposite side over the next 5, 10 years. So that's what my expectations are, is that energy will be the outperformer. Everyone is not really taking their energy bets at this time. And that is where the biggest opportunity in the markets resides, is in energy equities. And I don't care what energy it is, uranium, oil, natural gas, coal, I don't care. It doesn't matter. That is where the opportunity is at. The next one will be financials. This is all basically going to reverse to this side. And this, in my opinion, is going to move to this side over the next 5 to 10 years. And that has to deal with the market conditions, inflation, and interest rates. Now, that doesn't mean that in the short term that we won't get a scare or a pullback in the market before that occurs. We very well could get a slowdown in the market. That's why Powell's lowering interest rates, and maybe there's a slowdown in early 2024 or something like that, which gives us the best buying opportunity probably of like a lifetime if we get fear in the market. And I don't know if that'll be the case, but if we do, energy will be the best investment probably for the next decade, with what could be a very good entry point. So that is what the potential is. I think this will all reverse over the next 10 years. 6 billion people are growing per capita energy consumption towards Western standards. We remain bullish on commodities. This is energy use per person since 2022. Energy use not only includes electricity, but all other areas of consumption, including transport, heating, and cooking. And you can see where the energy use per person is incredibly high. You've got North America incredibly high. It's incredibly high over here, but look at all these areas where we are not using as much energy per capita. I think where a lot of people are projecting is that third world countries or countries that are not using the amount of energy is going to increase their energy consumption quite dramatically. I do believe that to be the case. That is what wealth is. Wealth is more or less energy consumption. No ifs, ands, or buts around it, really. So I think energy consumption worldwide is going to go up. I think fossil fuel consumption is going to go up through the roof. And I think nuclear is going to have to be adopted in mass over the longer time frame. If we run into fossil fuel constraints, is what I'm getting at. This guy says, I'm convinced the only reason people think home ownership is a good investment is because no one tracks the expenses. I completely disagree. Completely disagree. And I'll give you my viewpoint right here and my opinions. What people do when they compare renting is they only compare the first year or 2 or 3 or 4 of renting versus home ownership. So they'll say home ownership right now is more expensive than renting, therefore renting is better. That is their awesome long-term analysis that they have really put together, this gigantic analysis of home ownership. And then they'll throw in, well, renting is what I have to pay. Home ownership, you've got increase in property taxes, increase in insurance costs, and stuff like that. Okay, fine. So let's take my example and what I did and why I became a homeowner I decided to do that in 2016 or something like that. And I purchased I think it was early 2018 or late 20. I decided to purchase late 2017, early 2018. That's when I went under contract. So, and it took a while to find a house that I liked and that I actually got because everyone was outbidding me. So I had to go to a more expensive house. So my mortgage right now is cheap. It is very cheap. And I did this on purpose. So I bought the house in 2017, 2018. Transaction went through early 2018. My mortgage was $800 or $900 more than what it is currently today. I bought it and the property taxes were cheap as crap. They were like $1,700 a year. And my insurance was probably close to the same. I think it was like $1,500 a year at that time. And my mortgage, if I can remember, I can't remember the exact amount because it's way lower now, but it was a good chunk. So let's just say all of it combined, maybe it was like $1,700, $1,800, $1,900, something like that. Maybe was my full mortgage payment in 2016 or something. That's everything. That is your mortgage, your insurance, and your property taxes all combined. It was less than $2,000 for sure. And I did that. And to rent to rent a place, the renting was probably around $2,000, and I had to put money down. So someone would say, "Oh, well, that's not that big of a difference." Well, let's fast forward to today. Today, to rent that same house, it's about $3,200. That's what the going rates are of the houses that are of the same size and type of the house that I'm in my neighborhood. It's $3,200 a month. My mortgage went down, and I think it's less than $1,000 a month right now because I refinanced at the low rates. So that's the mortgage portion, and then my insurance and property taxes went up, and let's just say they're about $3,000 each. So that's about $6,000 a year. Let's just call it $500 a month. So I'm probably paying $1,400 a month. So at that time, renting and buying looked pretty close to being the same. But right now, if you were to look at that analysis and you look 5, 6 years later, however many years later, I am literally half the price of renting in only that short period of time. So if you were to take the full home ownership over the 30 years and you were to look at the full home ownership, the full costs and everything, I think renting is far more expensive because rent continues to go up and it goes up at the rent, the increase of price growth for the entire cost of the rent. Your mortgage gets locked in and inflation eats your mortgage away. And on top of it, my equity in the house has gone up massively. So my equity, I'm probably making money on my deal by a long shot than I am, I've probably made more money than I have in what this house has cost me. So I'm actually being paid to live in this house than it would be for rent, where you're actually getting charged money and it's a liability. Well, it's still a liability for me, but if I were to sell the house, I would actually have gained money. I would have lived here and I would have been paid to live in my house. For rent, I would have paid it and have nothing, absolutely nothing. And yes, I had one. I had to replace my roof. It was covered by insurance, and I have to pay the deductible. I got new roof and a new gutters, and I got paid also for some other damage that occurred during a hailstorm. I also had to put up $1,000 fence because the wind blew it down, one portion of it, and I split it with the neighbor. So there are some expenses that are in there, but I'm definitely way positive because I'm probably up 300,000 or something. Charts on crude net positioning of non-commercial accounts. This is managed money and other reportables in Brent and WTI futures and options combined latest value. So this has come down for net length in the oil markets, and we can see just recently it's come down even further. In my opinion, this is opportunity. Definitely an opportunity to be watching and looking. And this is also the net length coming here in billions of dollars. Look at these lows here, guys. This is where I purchased my other time in history. And then the other time I purchased, this is March, April. This is where I purchased gold and went up. And then I purchased all of my other stuff here in late 2020. I purchased a whole bunch of oil and nat gas. You can see the net length came back into the market. We are right at that same exact spot as those times that I purchased. We also have a ratio of 30 to 1, roughly 30 to 1. So looking at that net length, you can see it right there. Sorry for having it off the screen. It's right there is where I'm talking about. This is an incredible opportunity. It's like buying it at 2016, 2020, 2021. Looking at this chart, it makes me want to buy more. I just want to keep buying because it is such an opportunity and everybody is so bearish sentiment-wise. The companies are less risk. They've got cash flow. We're at a very low point. And I'll probably continue to pile in depending on cash levels at this particular time. I know Warren Buffett bought more Oxy. God, that guy is good and he is smart. And I agree with him. That's what I would be doing. XME. So XME, it says breakout, retest, and resumption. XME is the metals and minings ETF. We've got a clear break. We've got a clear retest. And we are starting to move on higher. This is an opportunity, in my opinion. It's looking very good for the metals and mining. We've got Stackers would be wise to buy gold and silver right now, in his opinion. That was the options expiry slam now over. So he thinks that this is option expiry slam and that we are going to see a potential move on up. That is his opinion. Do you agree with that opinion? Like to hear your guys' opinions in the comments. Is now a good time to buy gold and silver? I would say yes, myself. Metals and mining markets are extremely fragile. Don't believe me? Nobody worried about a copper deficit in 2024. Then one mine closes and every estimate flips from surplus to deficit. Here's the crazy part. Copper isn't even the most fragile market. 2024 will be fun. Let's get ready for this this flip in the deficits. There's a lot of metals out there that are projected to have deficits and are having deficits today, that are out there that we can take advantage and invest in. No one is thinking about this. No one is preparing for it. The only thing that I could think that could slow this down would be a slowdown in the market. That's about it. But yeah, the deficits are looking good. The Fed since November 1st, and again, guys, this is mixed signaling going on nonstop from the Fed. Getting inflation to 2% has a long way to go, November 1st. November 22nd, no indication of rate cuts at last meeting. December 1st, talks about rate cuts are premature. December 1st, we are prepared to tighten policy further if needed. December 13th, 2 weeks later, rates have peaked, 3 rates coming, cut rates, coming in 2024. December 15th, Fed isn't really talking about rate cuts. What is happening here? I don't know either. Like, they're going back and forth, left and right, up and down, contradicting themselves. And then someone says, I just take Powell, I'll take him for his word. Whatever he says, he's been real upfront. Guys, he's been all over the place, wishy-washy the past month. This all occurred in about a month's time frame. I don't know. It seems not very, he's not projecting a steady, reliable form of communication, of what he's actually communicating is switching. It says when growth investing switches to value investing, you could be in it for years. The 1970s and 1980s were all value. The 1990s were all growth. Then from 2000 to 2007 was value again. Growth dominated from 2007 to 2021. The peak was in November of 2021. And you know what's causing this? The demographic and the real estate cycle. So the demographic and the real estate cycle is causing these valuation shifts, and the interest rates are the main factor in the credit expansion during that time. Credit expansion, value outperforms. Inflationary periods with increasing interest rates, value outperforms. We are going to see an outperformance of value here in the future, in my opinion, just like he has here in this graph. That would be my projection as well. So that this is what's coming. It's going to be an outperformance of value. Value is going to be low PE, commodity companies, energy companies, all of that stuff. And you can even see it on that first chart that I went over, which is energy's underperformed. That's going to swap with tech. This is the value portion over here, and this is your growth over here. So that's all going to rotate just like this chart is showing here. It's all going to rotate. Just wait till Powell pours kerosene on this. Feel bad for the pod shops betting on recession. So manufacturing construction spending in the U.S. continues to hit new record highs, increasing 71% over the last year. And this is where that strength, some of the bullish strength in the market is showing up. It's showing up in manufacturing construction spending, up 71% year over year. Now, is it possible that we get a slowdown in the market, like a technology recession, like the tech, the tech boom in 2000 and then the tech crash? I think that's possible, and I just don't know how the market will necessarily react in the short term. So, I see this information, and I'm like, man, this is a huge portion of the economy. This is where a lot of the jobs come from, is manufacturing construction. And looking historically, a lot of the recessions came after construction employment went lower. We're not seeing that slowdown in construction employment. We're not seeing it in construction spending. So that's what makes this all incredibly difficult to try to time, because, and I'm not trying to time it, guys. I'm riding through this. But if people are trying to time it, you're getting mixed information here in the short term. I don't know what's gonna necessarily win in the short term here. Construction spending's up, but yes, credit card debt and all these other things do look pretty bad. Loaning has definitely declined. So what's going to win in the end? I don't know. We have to wait and see. So basically, the Fed rate hikes did nothing to slow the economy, increased our federal deficit, and did nothing for price stability. The fact that the market is higher at the peak of rate hikes versus before they started basically means it did nothing. Name one thing it fixed. Well, that's it. The rate hikes take time to basically be absorbed into the market. They take about 12 to 24 months. So yes, they did rate hikes, but the full effects of the rate hikes haven't been felt yet. And it definitely has had an impact on the housing market and sales volume. It's had an impact on real estate. People who make money from real estate because your volumes have declined massively, your sales. So it didn't fix anything, but yes, it could also create a debt crisis. And that's where they're kind of, they're put in the corner and they have no way out of this thing. They don't know which way to go. It says this is exactly how the 2008 financial crisis unfolded. And then you can see we had a market peak in 2007, and then we came back down. Now, before this, the housing starts peaked in 2005. We had a massive increase in housing inventory from 06 onwards. So this was completely projectable. You could project that something like this could occur in a hyper supply phase that we were in at the end of an expansionary phase, and that's when recessions almost always occur. Now, here's another cool thing. If you look at how this thing bottomed in 2008 and 9, this is a shoulder, a head, and a shoulder that developed, and you could put the neckline across here. And this was a big bottoming pattern that led into a gigantic move to the upside for the markets. We are right here in a lot of our commodity stocks. They all have these inverted head and shoulders from the fall. And we're at the bottom of this basically right-hand shoulder. We can see it in energy service companies. We can see it in a lot of the oil and gas exploration companies. And the head and shoulder size is absolutely massive. The size from the neckline to the bottom here. They are the biggest inverted head and shoulders I've ever seen because oil went negative at the head of this inverted head and shoulders in oil. So this here, I'm using this as the S&P 500 index. I'm using this as an example to show you what a bottom looks like. And in 09, we put in that bottom. The buy was right here, and if you could time it coming up off this bottom here was a really good spot because there's a lot of fear in the market. And then you have to ride it for the 10 years. Right now, energy companies possess the same setup as the S&P 500 did in 2009. It's the same exact setup. I can show you. Let me pull it up just to show you guys a setup using XOP, just to show you that I'm not, feeding you some crap. Here's XOP, and there's that inverted head and shoulders. That's the shoulder, the head, and the shoulder that is developed that we're going to break and move to the upside. On logarithmic, if we were to blow this up, there it is. And then if we were to look at the projected price move, it's $839 from 136 of where we're at today. That's the projected price move of that inverted head and shoulders. It's the same inverted head and shoulders as this right here. It's the same thing. And we're at the right-hand shoulder right now of where we're at over here. So I just want to make sure you guys understand kind of where we're at and how this is all playing out. And this isn't the only sector that has an inverted head and shoulders. There's other companies, other sectors, energy service, and all these other ones that I follow that have these similar inverted head and shoulders. You can even yank up some of these uranium companies, and they have it too, depending on where you put the neckline. Copper, Goldman Sachs foresees a supply shortfall that will drive the price of copper to $4.50 per pound by late 2024 and to more than $6.80 per pound in 2025. And these deficits that are coming in copper are going to push the price higher over the next few years. It says, out of the brushlands of West Texas and New Mexico sits an oil field that produces more oil than Iraq, Iran, or Canada, the Permian Basin. This remarkable fact is somehow not widely known. Living in Austin, not exactly an oil town, I bring this up whenever I can. It talks about this. It says the remarkable Permian Basin at over 5 million barrels per day. The Permian Basin of the West Texas and southeastern New Mexico would be the third largest producing country in the world. And some people are talking about this potentially peaking out at some point. And this is how much of a contribution the Permian makes. It hasn't peaked yet. It very well could peak in the future. But look at how much this is contributing to the world oil production. It is a big deal. So that is one thing that you want to watch if you're looking at peak production. QE Infinity, Bond King Jeff Gunlock thinks we broke key support on yields with the 10-year below 4%. Sees a recession and the 10-year yield in the low threes in 2024. And that's where we're getting this, differing. It's a differing between people who think we're not going to get a recession and people who think we're going to get a recession. The recession camp, they're they have validity to it, and that they're looking at the declining yields and the uninversion of the yield curve, which almost always precedes a slowdown in the market. Other people are looking at construction spending and other metrics where they have declined before recessions, and we can do that real quick here. I do have some of those. One second here, guys. Let me blow this back up. And let me go back. Let me go to U.S. construction spending and show you kind of before those recessions. So this is construction spending here. And if we were to take kind of a big picture view look at this, a lot of the times construction spending has declined before recessions, almost before every single recession almost. You see a decline in construction spending almost every single time. And is this going to decline? We don't see it yet. So this is all employees construction. You can see that we've got these recessions, and this preceded almost every single recession. This one was probably a result of the recession, maybe, but we see that decline. So we're trying to see, are we going to see this in all employee construction spending? But we just saw that employees are going up and construction spending is going up. This is total residential construction spending. It's been going back up. Maybe you could have said that we already went through the slowdown. But I mean, this is massive construction spending slowdown in a lot of these cases. And this one resulted in a slowdown in 2020. But we're not seeing that in some of the data. So I can understand both sides of the argument, and I don't know who's going to be right. We'll have to see the yield curve actually uninvert. Like, it actually has to come and uninvert. That hasn't happened yet. Global coal use at all-time high in 2023. Global coal use is expected to reach a record high in 2023 as demand in emerging and developing economies remains strong. The International Energy said Friday. We also have real estate XLRE. That looks like a clear break to the upside. If there was a recession, and we were to look at some of these like XLRE, we could just take a quick look at it. You can see that turned over February of 2020 pretty rough. It was going sideways here. We don't have enough data really to show you. But to me, this looks like it's bottoming. And if I were to do just a crayon graph here, that's a falling wedge that's broken to the upside. So what makes us think if real estate and home builders and the financial sectors, they're all breaking to the upside, what makes us think that this recession is necessarily going to come if everything's breaking to the upside? Again, that's what makes it difficult. The people are positioning for a move higher in all of these assets. The market is not positioning for a recession at this time. But yields have come back, and maybe there's a disconnect between stimulus money coming through the system, a stimulus overhang, which is going to draw yields back down. And maybe we don't have a hard landing. Maybe it is a soft landing. I don't know. Tough to say. It's tough to say. The Fed has been using some shadow bank in Japan to launder money into the Treasury. A bank nobody has ever heard of is a top buyer of U.S. government securities. That's kind of interesting too. I won't go too deep into it. Copper is saying that the odds of recession are declining. So we are seeing the price of copper go up. But is copper now a good indication of recession or not? And I don't know, because as supply gets impacted, maybe it's supply driven, not demand driven. And all of those other indicators were not supply driven, but demand driven. And that's where it becomes difficult to get a good gauge on this. And that's where I'm going to end it, guys. That's what I've got for today. So that's what I've got for today. Thumb up for the content. Subscribe to the channel if you guys haven't. Subscribe to the website if you're interested. Lots of good opportunities out there. The charts say we go higher for a lot of the commodity stocks. The yield curve is still inverted, and it hasn't come uninverted yet. So maybe there's still more time in this. Difficult to say. U.S. construction spending and all those metrics look good for a move higher, not lower. Home builders are taking off to the upside. XLRE, which is the real estate sectors, are going up. Metals and mining sectors going up. Copper's going up. Palladium looks like it's bottomed. It's going up, and short covering is occurring. I would find it very difficult to say that a recession is going to occur immediately. But that doesn't mean it can't occur later. So we'll continue to monitor the yield curve. We'll see if that uninverts. Generally, when it uninverts and hits certain areas, a certain level, that's where an increased likelihood of a potential slowdown or a crash or fear entering the market could occur. So that's what I've got for today. It looks like everything's still looking quite good for commodities. And that's where I'll end it. So I'll see you guys later. This is Finding Value.